Well, good afternoon, everyone, and thank you for joining us for this Capital International webinar, where we're going to look at 7 crucial ESG considerations for trustees and also explore why biodiversity matters to markets. And I'm delighted to have Tom Rutherford from Lotuk Consulting joining us today on the webinar. Tom has a background particularly in biodiversity and working alongside family offices and trustees. So, Tom, welcome. Thank you ever so much for joining us today. We'll start by just covering a little bit of the content, also just a bit of admin. We have got some poll questions that you'll be able to see in the stage setting. And if you'd like to ask any questions, we'll have a Q&A session in about 40 minutes time. Please do pop your questions down in the chat section. And we look forward to hearing your feedback. So in terms of the format for today, really going to look at it in 2 parts, looking at some of the practical applications for trustees when considering ESG, and then looking at biodiversity in a bit more depth and detail, and really picking Tom's brain in terms of some of those kind of key decision areas. So if you're starting out and looking at it from a fiduciary perspective, and you have a family or a client that has shown an interest in either ESG in general or biodiversity specifically, what steps do you need to look to go through? So during the webinar, we'll have a look at an initial step of reviewing existing portfolios, conducting quantitative and qualitative analysis, ESG ratings. We'll then also look at the sort of questions that families and clients should be asked to determine their own ESG objectives. We'll then look at how you align those ESG and biodiversity objectives with the more general investment objectives and your investment horizon and risk profile. We'll follow that by looking at some of the practical applications that we're seeing from trustees in terms of adopting an ESG framework. So that may be looking at an ESG letter of wishes or looking at a family constitution that embodies or includes ESG and biodiversity considerations. We'll then look at the practical step of how to adopt ESG criteria within an investment policy statement, and then move on to look at asset allocation from an ESG perspective, ESG manager and biodiversity manager selection, and then probably most importantly from a trustee's perspective, once you've established an ESG manager relationship, how do you monitor that ESG manager and what sort of reporting should you expect to see? So if I could bring you in, Tom, here, I mean, and just to open the question really, and from your perspective, why do you feel that biodiversity matters to markets, and perhaps sort of a comment about the recent sort of G7 commitment that we've seen and their communique?
Oh, Greg, well, thank you. And first, thank you for including me today. Good afternoon or good morning to everyone, depending where you are. Why does biodiversity matter? Well, of course, we're beginning to realize that biodiversity is the other side of a coin, absolutely entwined with the climate change crisis and emergency. So it matters very much. And so many of the issues that are raised through biodiversity, which you've listed out on this page, are absolutely affected by climate change and indeed, causal in nature. In case this isn't already apparent, I'll probably draw your attention to a very recent event down in Cornwall with the G7 meeting. And one of the communiques that came out of that from the leaders of certainly, well, the Western world was, of course, a note around biodiversity and just how serious the crisis is there. So the reference there to 30 by 30 is a phrase that you may have come across before. It speaks to this objective, this political objective, that by the year 2030, 30% of the world's land base and indeed marine ocean environments will be formally protected, such as the degradation that's otherwise continuing at the moment.
Yeah, thank you, Tom. And I think often the assumption with biodiversity is that it's all about planting trees. And actually, I think one of the things we see as a discretionary manager working on the equity and the bond side is that actually companies are going a lot further now. And as a manager, we're assessing factors like land use, nature loss, particularly looking at sectors like agriculture and really looking all the way across their value chain, what's upstream and what's downstream, and their impact on nature. Whether that's looking in an area around deforestation and loss of land for agriculture and sort of monoculture crops like soy or palm oil and seeing where they sit within a company's value chain, to something a little bit more fundamental, looking at things like zoonotic risks, and I think that's something that prior to the pandemic, most people will have not come across zoonotic risks, and I suppose just to put that in a bit of context, we've now seen significant economic impact from the pandemic, and these zoonotic risks, it can be linked back to biodiversity loss and that sort of link between one species and another species, our invasion into nature, causing a pandemic that has massive societal and economic impacts. Tom, we've got later in the year, we know we've got COP26 coming up from a climate change perspective, but there's another conference coming up this year as well, isn't there? And just wonder whether you could give us a little bit of detail about COP15 and the Biodiversity Conference.
So the world of sustainability is one of alphabet soup, I think. COP15 specifically relates to the convention around biodiversity and actually was scheduled to take place last year in China. For various obvious reasons, it's been delayed to just about the same time as the Convention on Climate Change, obviously in Glasgow. And we're looking, interestingly, for similar outcomes that we achieved in Paris way back in 2015 in terms of global commitments that will elevate in a formal policy and ultimately a regulatory sense to ensure that biodiversity is and nature is protected. What will that impact? That would obviously impact on fishing, that would impact on land use, change of land use, that will have initiatives around pollution, and that will have initiatives around such things of agricultural practice and soil degradation, really key elements, which, as I say, are wholly is considered, alongside climate concerns, since they are so linked. So quite a lot to be achieved in the fourth quarter of this year, if we get the outcomes that we both desire and indeed expect.
And this is the sort of second attempt that the biodiversity COP has had, really. In 2011, they came out with a series of targets, the Akai targets, and they've really failed to be met. So I think a lot of participants today, trustees, will be aware of the Sustainable Development Goals and actually how we're now seeing strategies, portfolios, fund managers aligning to sustainability development goals, and to an extent we're seeing structures and clients aligning to those as well. And I think COP15, the objective there is to have a similar set of goals from a biodiversity perspective that companies can then start to measure themselves by, and we're starting to see that just in the wake of the G7 communique. We've seen two of the direct equities that we cover, Schneider Electric and Ørsted, come straight out with a net positive biodiversity impact statement by 2030. So I think we've seen most companies coming out with their sustainability and impact reports and their commitments from a climate change perspective. And Tom, are you expecting to see the same now happening from a biodiversity perspective over the next couple of years?
Oh, without a doubt, and that's an interesting mechanism that you referenced on the climate change front, because I think that will be echoed on biodiversity. It's not really intuitive. How would you achieve the equivalent of carbon offsetting and an obligation to have a sort of a net zero outcome. In fact, the political ambition is a positive nature outcome. But that actually sets up a really interesting opportunity for investors, because if you're a corporate, if you have to report on these factors, how do you end up with a net positive outcome from a nature sense? Ultimately, there's a taxonomy, the same that we have on the carbon side, that will, obviously penalise and imply a financial penalty to offset, what has been a sort of a carbon emissions outcome. But doing that for nature does imply that actually there's got to be serious investment, again, by governments, by corporates, and ultimately to the benefit of investors, because there will be so much capital investment in those outcomes. And therein is the opportunity, not just the financial risk and litigation risk of getting it wrong, of course, quite apart from the poor societal outcome.
Yeah, and it's I've put a slide up here that shows our biocapacity, and really just to sort of show that since 1970 we've been living beyond our biodiversity means, if you like, and whether that's across cropland footprint, grazing land, and sort of the impact from a consumer perspective around meat consumption, forestry product footprints, fishing grounds, which you mentioned, and also just the sheer fact from a demographic perspective, we've still got a growing global population, and our built-up land footprint has increased over the last 50 years. So if we then look at a particular sector, and this is one that I suppose from our perspective is quite key, because we see a lot of the investment opportunities within a sort of a revolution really within agriculture. We've seen what's happened in clean technology over the last 10 years, and in many ways we're sort of almost at that 2015 point now for biodiversity, as we were for clean energy sectors. And just to put a bit of colour to that, and we're just highlighting here the impact that agriculture has. The obvious one is deforestation. 80% of deforestation globally is as a consequence of agriculture. But perhaps one that gets overlooked is that 52% of agricultural production land is already degraded. And I think that often the emphasis, the focus within ESG generally tends to be around clean energy, clean technologies, energy efficiency, EVs, that whole space. I think there is a whole world of change, technological advancement that we're starting to see happen within agriculture as a sector.
Absolutely, and some of those on the call will already be aware of the opportunities that arise in, beyond clean tech. Ag tech is a very obvious area, and we'll look at some of those opportunities later.
And we'll come back and maybe talk about water usage within industry as well, and sort of assessments there from a biodiversity perspective. But I think one other point we also wanted just to highlight, and again, this is something that's slightly academic, but actually from an investment management perspective, when we're assessing companies' equities, or whether we're assessing issuers on the green bond side, we're now sort of factoring in different planetary boundaries that have an impact on the way that we see companies. And I think it's something we're starting to see families and clients start to shape themselves as well, and perhaps they have a particular focus, particular area that they may want to tilt towards. And the diagram that we have here just sort of highlights where we are across a number of different boundaries. Essentially, if you're in the green zone, you're in a kind of safe area, and we're kind of using resources at a suitable level within those boundaries. If you're in the orange sector, then there's an increasing level of risk. But probably the most important bit is when you step over into those high risk zones. They're tipping points. They're almost setting off biodiversity negative impacts that really become sort of outside of humanity's control. The biogeochemical flows element there really links back to agriculture, when you look at the use of fertilizers and how nitrogen, for example, gets into ecosystems. And I think it's that sort of analysis now that we're starting to see families pay more attention to. And actually, if they're coming from a place of what legacy are we going to leave for future generations, for beneficiaries and future beneficiaries, I think, yes, you're always considering the financial returns in the short and medium term, but actually looking at the biodiversity impact over the longer term is becoming more and more relevant. I think, Tom, the other area really, and to ask you the question, when you're working with managers, working with families, how often is biodiversity coming up as a talking point? And I suppose our view is that it's really next on the ESG agenda. I mean, are you seeing that in your conversations with families at the moment?
Without a doubt, and it's tempting to say it's a generational issue, as is sometimes the case, but there are lots of investors who have been perennially concerned around the impact that normal corporate practices and our lifestyles have had on in particular marine welfare. Anyone involved in agriculture directly themselves will also be very concerned around soil degradation and the maintenance on crop yields. So again, these are issues that if you're involved in those verticals, you'll be well aware of. But yes, I'm seeing a number of families ask the questions around within an environmental sphere, particularly around biodiversity, which is encouraging.
So I think that sort of is a sign then that actually managers are engaging now, but actually, whilst it is a relatively early stage, that there are significant investment opportunities to be found, whether that's in the private equity space, which we'll come on to, or the increase in things like green bonds and very specific finance for biodiversity specific projects. And so we also thought just for participants, it might be useful just to provide a couple of case studies, recent ones that we've seen and that are now live investment strategies that we're running for clients. So the first one we thought we'd share is we've recently established a multi-asset ESG portfolio that we tailored, and it was using an inclusion approach rather than an exclusion approach. But the objective that was set was that of sustainable value creation whilst mitigating climate change and biodiversity loss. So it sort of went beyond just focusing on climate issues and actually specifying biodiversity loss as a criteria that we would be measured against when we're managing the portfolio. The second one, and for any pension trustees that have joined us today, we're certainly seeing a rapid move from pension trustees that are shifting, in particular, their fixed income mandates from a traditional corporate bond portfolio to one that is not only looking at sort of ESG scores and ratings, but also looking now at the universe of green bonds, which we've seen increase. I mean, the size of the green bond market now is in excess of $1 trillion, and I think we will see increased activity in that area as pension trustees and institutional clients start assessing their fixed income portfolios. And probably the takeaway point from that was that we saw the yield to maturity not being impaired at all, taking a green bond approach. The duration being very similar, but what we did see was that for those issuers that scored better from an ESG perspective were of a higher credit quality. And so that's something we'll maybe come on to a little bit later, but I think there is certainly an element of looking at risk on the fixed income side, and those companies that are assessing ESG risks are in a better place to manage them. The third case was quite an interesting one, really. The settler of a Guernsey structure It was a dark green environmentalist. He'd been at the Rio Convention back in the early 1990s. Yet he'd had a traditional Swiss bank portfolio that was packed full of toxic assets. So in that instance, it was really a case of a complete reallocation and to a full ESG strategy. Interestingly, that client, I was speaking to him earlier on, he's now in the process of acquiring conservation land in Costa Rica, which has a biodiversity corridor. So it's interesting now to see from a trustee's perspective what clients are wanting to achieve and wanting to do with their liquid assets, but how that might also complement their activity from a conservation perspective. And we'll sort of come back to those case studies as we go through these seven crucial steps. So, Tom, the first two steps that we wanted to look at, and say you're starting out as a trustee, you have a client portfolio, and perhaps it comes up in conversation that it might not be a bad idea to consider or start to become more ESG aware. Tom, where would you be starting in terms of conducting a sort of analysis of an existing portfolio?
Greg, thank you. I'm thinking of that joke about asking directions of a local when lost, and the response is, well, I wouldn't start from here. No, seriously, the first point I would make at starting a conversation is exactly that. Before you get formal on your intentions, is obviously to lean into the real, genuine passions and interests, the values, I think we should term them, of the beneficiaries and the owners. There's a point here because ultimately people are true to form, and that's what direct their behaviors. So what are those lifestyle choices? What are those philosophical beliefs, those social economic motivations, and indeed any faith-based inclinations they have? These are really important to incorporate. You're not going to get it right straight off. And so often the starting point is actually with the inspection and the discussion with your managers to find out where they lie on those particular issues. So be specific. Do lean into certain issues over others. Here we're talking about biodiversity, but it could be your clients have a motivation around social justice, social welfare, even governance issues and corporate engagement. But particularly on biodiversity, I'd make the point that if you're going to use the data, look at the data, be careful. A lot of the data out there, or at least the headline ESG ratings that we're beginning to get used to, often dilute those very specific factors around deforestation, land use, pollutants, other more specific indicators you look for. So you've got to get into the detail ultimately, and that's an educational journey.
Yeah, and I think that element of tailoring those ESG criteria with a family is so critical to establishing a portfolio that is aligned to their objectives. And we could take an example. We have a lot of clients where the underlying client is in South Africa or Southern Africa, and for them often governance is the biggest issue. Because they're so used to seeing poor governance locally, and they're also at the raw end of a lot of the biodiversity loss. So we have a couple of clients that are farmers in Zambia. So that sort of talks to your point around, well, if they're in agriculture, they're probably going to have sensitivities around that area. And I think the I suppose biodiversity specific impacts, and we mentioned them briefly earlier, but we're now seeing the analysis in far greater detail of what is upstream and downstream of a company. So if you're reviewing an existing portfolio that's holding a company in a particular sector or space, perhaps say it's in consumer staples, it might have a huge chain of different sort of impact zones, if you like, up and downstream. And I think that's where the level of analysis and detail is increasing. And I think probably one of the biggest challenges for a trustee is to engage at an appropriate level, so that they establish the framework, they establish the objectives, but actually they're working with partners that can provide them with that that quantitative and qualitative analysis that goes beyond just looking at what an ESG rating might be for a company or for an asset. I think the other practical application is clients are at different stages on their journey with regards to ESG in general. For some, it might be part of the portfolio. It might be they want to make a few sort of direction of travel steps towards an ESG approach. And I think it's that conversation piece to assess what direction from an ESG perspective and at what pace those changes can be adopted. And we're often now seeing that the mandates might be aligned to specific SDGs, for example. And I think we'll see that increasing. I think once you've kind of taken those early steps, I think the next stage becomes sort of how do you analyze and plan? What are the real considerations you need to be thinking about once you go from the sort of philosophical into the practical? So I think aligning those ESG objectives with your wider investment objectives. I think then also looking at it from a risk perspective, and say you have that initial conversation and it doesn't go anywhere with the client. I think there potentially is a sort of a fiduciary duty element coming into play now, where the financial risks of not considering ESG has to be factored in. And perhaps, Tom, and you could talk a little bit about some of the legislation and policy risks that we're seeing that might come out of COP26, or perhaps the sort of recent example we've seen with the court case brought against Shell in the Netherlands.
Yeah. Well, I mean, that was a case brought, wasn't it? Where the Shell had not lived up to prior commitments, and shareholders were challenging that successfully, I might add. We're seeing the rise of shareholder activism, reflecting the sense of urgency that's so often shared on these factors. In terms of the regulatory direction, I mean, interesting, in the UK for pension funds, of course, you've already got an obligation at the very least to publish or make clear disclose your policy around climate change, which takes into account an assumption around transition risks and physical risks, and how that will affect the value of the assets. Now, I think within that area, specifically as relates to fossil fuels, we got quite used to the notion of stranded asset risk, i.e. Impaired value of the assets we own. I think we're beginning to get our heads around some of the litigation risks, and certainly the insurance industry is having to spend a lot of time thinking about that. And more broadly, of course, we've now got these quantitative frameworks for assessing, pathways on climate change, and the implications sort of mathematically of a certain set of assets, of whether that implies a net zero outcome or not. Now, why is that relevant? Because, of course, I come back to the notion of a taxonomy, that your net position as a corporate, as a large asset owner, is itself going to be, one, subject to scrutiny and reputational comments, or two, ultimately it's going to incur a penalty, either directly as a corporate or indirectly through those assets you own. So it's in your interest to bring down those aggregate negative exposures, or should I say gross exposures, to exit those assets, but also look at those offset mechanisms. So as we start thinking around positive for nature, so corporates are going to be motivated to invest in those activities that give them a positive score and put them the right side of the balance sheet. So those financial factors are ones that all trustees are ultimately going to have to consider, or ensure that their managers are actively considering.
Yeah, and I think that's one of those kind of key practical points from a trustee's perspective, is the challenge of having to address ESG, having gone through substance, having gone through FATCA and CRS and BEPS, almost in a way that there is an element of what is your position as a trust and corporate service provider, or as a family office, in terms of how you're going to record that data yourselves. And we've seen it in our own business, whilst we are discretionary manager, custodian, and now a bank. We have our own ESG forum. We have our own ESG manifesto around what we're going to do as a business, and we're looking at our own sort of footprint from a biodiversity perspective now. So I think there will come a time when yes, you're looking at your liquid assets, your investment portfolios, and assessment of that, but also the overall sort of structure that you're administering for your clients and what is its position. So, and I think one of the ways perhaps that we're starting to see that being adopted is through family constitutions that have a policy around ESG and biodiversity, perhaps ESG letters of wishes that provide guidance for trustees, factors like having a protector that maybe has the power to veto an investment decision if it doesn't meet certain ESG criteria. So I think that sort of highlights a little bit some of the risks that need to be considered. I think, Tom, if we perhaps now look at one area that I know you've certainly got a lot of experience in, is where are some of those opportunities specific to biodiversity? And we spend a lot of time focusing on equities and where we might see biodiversity leaders in that space. And that's probably been the earliest area from biodiversity perspective. We're now seeing it increasingly in green bonds, but I know in the private equity space, you almost get to see it before we do. So perhaps if you could just sort of highlight what you're seeing in the market at the moment, Tom, I mean, that'd be useful, I think, for everyone to hear.
Absolutely. Thank you, Greg. So we're talking about a secular environment that I think is long-term positive here. So that's the point. There are a lot of new disruptive technologies that seek to solve the problems of sustainability. And we're used to seeing them within the renewable and energy efficiency space. As you mentioned earlier, we're now seeing them in the waste, the agricultural and the water efficiency market as well. And I'm not talking necessarily about new startup ambitions. I'm talking about established commercial entities that typically of early stage, mid stage life cycle, originating in the post GFC environment, that are well beyond proof of concept, are commercialized, probably already profitable, probably have several hundred million of turnover, and are seeking expansion capital in order to bring new products to the market and obviously expand their services often to new territories and jurisdictions. And that is where I think there's such an interesting opportunity. Usually privately owned, often on the equity side, sometimes on the credit side as well. To give a couple of tangible examples, within water utilization, the treatment of wastewater, industrial wastewater in the US is a big market. The Environmental Protection Agency in the US is probably way ahead of its European equivalents in terms of the standards they imply, and by applying them on the corporates that emit those wastes. Mm-hmm. In Europe, we're seeing a lot of opportunities out of Northern Europe around particularly domestic waste recycling, real time, often using sort of medical dialysis technology, very interesting, and quite a popular growing consumer market. But in the agricultural space, a manager that I'm working with has got very interesting investment in a company that collects animal waste matter and anaerobically has an anaerobic biorefinery that turns that into one natural gas and two slow release fertilizers, which obviously have a more a kinder ecological footprint than phosphorus based fertilizers. So lots of opportunities, as well as of course for some of your clients will be interested in early stage opportunities that they can get in the venture marketplace and obviously take a significant ownership stake.
Yeah, and I suppose we see some of the fruits of that work coming through in later stages. We're now seeing some IPOs in those sorts of areas. I was just thinking of Oatly that came along very recently. Obviously, from that sort of land use biodiversity perspective, when you're looking at sort of green consumerism, I suppose we're seeing that increase of companies coming through the pipeline. And whereas maybe 5-10 years ago they were predominantly in the clean energy sector, I think that sort of pipeline of cases is now changing, and as you say, covering sort of agricultural technology, where we do see obviously a lot of biodiversity benefits. And
so the point that, if I may, Greg, I just jump in there. You made the point earlier, it needs to be emphasised, is that we're not talking about a concession on returns to have a positive biodiversity impact, but somehow giving something from a return perspective. It's possible to be more impactful that you have to sacrifice some liquidity, and indeed possibly there's volatility implications, but certainly on a long run basis, and for those that have those tolerances, it's a very interesting time for investors.
Yeah, and that leads on very suitably to our next point, Tom, that actually almost the point at which we think families and trustees are looking at it now is sort of, if you're wanting to leave a positive biodiversity legacy, that you should start putting some planning in place for that, and what that looks like, and that is where we're seeing, certainly on the equity and green bond side, that universe is there now. So if the intentions, the wishes are there from a client perspective, really there's nothing limiting you in terms of being able to implement that strategy. It's really going through using the process, the framework, and engaging with your clients, and then talking to managers that have expertise in those areas across those asset classes. And I suppose that next natural step then is sort of, how do you go about adopting and implementing an ESG and biodiversity strategy? And I think what we're seeing now increasingly, that is forming part of investment policy statements being referenced there. I know there's a point that you make, Tom, that you don't want to get too specific in that level, but I think it's good that it sits there, that there is it is referenced in the investment policy statement, and you almost have your ESG objectives and ESG restrictions, and likewise for biodiversity stated in that form.
I think absolutely right. I see the policy statement as the opportunity to declare one's ambitions and wishes, notwithstanding a letter of wishes, but you get my point. It's normal for fiduciaries, large institutions, to include sustainable policies within that headline IPS, and in many ways it should represent the statement of intent and the art of the possible. Certainly it can set out objections, things that are unacceptable, but I think in general terms the specificity, particularly around reporting obligations, are probably best put within the mandates, so that you can keep your managers honest and hold them to account. The reason being, of course, that the landscape changes, the specific measures change, the exact requirements, your own requirements, might need to be revisited. So it's probably better to have a broad policy at the headline level, but just get down into the detail at the applied level, is my thought.
Yeah, and I know you had one instance a few months ago. We were talking about where actually the kind of ambition was for a portfolio to be managed in harmony with nature, which sounds very, very broad, but actually that then gives you the freedom and the scope to be able to sort of be unconstrained really within when you're looking at constructing the portfolio. And I suppose then the next steps is sort of what approach do you want a manager to take? Are they going to use positive screens or exclusions? Are they going to take an impact approach for a certain part of the portfolio? Are you going to have separate managers managing a green bond portfolio, private equity, and maybe a biodiversity leaders strategy, and how they all sit together? I think that the other element that you've mentioned is you need to have something that's dynamic, that can reflect changing objectives, whether they're generational changes or whether they're the pace of change in technology across a lot of sectors will lead to different investment universes becoming available over the next couple of years. And I think that's almost the exciting point for us as a manager, is that there isn't a day that goes by without some form of discovery, and when there's a form of discovery, there's always the potential for alpha for clients, which as investment managers we've always got to be sort of very conscious of, as well as sort of protecting on the downside and managing risks. And I suppose, Tom, there's no substitute there for knowledge and
without a doubt. Okay, this is the key point, as listeners patiently sort of imbibe hopefully some passion and enthusiasm we have for the topic, there is the serious point here that when you're selecting managers to achieve, such outcomes, specific and intentional investment strategies, you're going to have to find authenticity. Mm-hmm. The idea that the specific understanding of nature loss, land use, pollutants, the sourcing of product, responsible sourcing of products, and there are real issues within the beef industry, the soy trade, even within forestry, pulp and paper. It requires a manager who's prepared to get into that detail and look at the underlying factors that are impacting on their investment companies. You can't do it with just headline ESG rankings. You can't do it obviously without a subjective analysis of those factors, because you will find good and bad often within the same investment opportunities. Now, it's not my role as a consultant, as an advisor, to pick holes necessarily in a manager's view. They're the experts. They've got better access to the data. But it is, I think, beholden on all of us to identify that authenticity, that real investment of resource and knowledge to understand these factors. And that's why it's a specialist activity.
And it's funny how things have changed over the course of sort of 10 or 12 years. I struggled for 3.5 years to try and raise capital for sustainable agriculture and forestry funds. And at the time, we'd get a lot of interest in it. They'd find it fascinating, but it was too niche. And I think that's one massive difference we're seeing now. It's become mainstream, probably only because of the increased significance and the awareness of biodiversity as being as critical as climate change, but also that sort of pressure that's building up from a global governance perspective that we're now seeing reflected in policy and legislation coming through, and really biodiversity being put on the radar properly as something that does have an impact from a financial perspective. And
well, you're very well placed now, Greg. You and the team at Capital are in the right area, I'm sure.
And I think that's one of those. The other points is, once you're looking after an ESG or biodiversity strategy, it's how do you go on in terms of providing reports, and what does that process look like? And I think if you're a trustee and used to receiving a regular quarterly report or regular monthly report on your investment portfolios, you should expect to see a sort of an ESG update on a regular basis that's relevant to the strategy that's being managed, and should expect to see actually quite a lot of detail in terms of what's happening at the underlying asset level. And I think one of the things we've seen over the last couple of years generally is that increase in transparency. Now, I know a lot of trustees are too busy looking after clients and administering structures to dig into sustainability reports and impact reports, offering documents. But I think it's important that information is made available by a manager, so that if a client wants to be able to see, well, actually, what am I exposed to from a biodiversity perspective, it should be there for them to be able to assess and to see. I think that that kind of relationship that builds up perhaps between a trustee, their manager, the underlying client, and a specialist that's there to provide a sort of oversight capacity. We're seeing that space really growing, and I think for trustees that perhaps it is part of their approach in terms of looking after existing and new clients, that they almost want to be that kind of have that ability to say, look, in the same way sort of banking, if you're a trustee, you want to know you've got your panel of banks you can go to. I think you also want to know that you've got the that ESG expertise at your beck and call to be able to provide an update, an overview on any asset class, any area, any sort of major biodiversity or ESG factor that might be material.
Absolutely. And of course, by investing in that process and bridging that dialogue between managers to specific issues and reporting to to the trustees and indeed the beneficiaries, of course, what you're doing is you're bringing the beneficiaries closer to the issues that motivate them. And getting their involvement, and I never find that emotional involvement is detrimental to trustees and those that are serving their interests. Only additive. The data is there to be helpful, and so I just make the point that when it comes to reporting, we should be asking for the relevant information, probably leaning on the outliers, identifying the outliers, the good and the bad. The very least, that elicits the conversation of why managers have those positions, to prove that they've thought about them, that they're reflecting those wishes properly. But of course, they are the experts, and they might have a view that a given company with a poor record is actually turning itself around as a result of a policy or management change. And that's a good investment opportunity, of course. The data flows generally are only going to improve because the disclosures and the obligation to disclose is only improving. So whether you go for public source data, or depending on the type of strategy, it might be the sort of data scraping of social media sources and more opaque information, AI-based information. That information is all useful and helps inform a position.
Thanks, Tom. There was one bit just whilst you were chatting there and explaining that came to mind on a recent case we were talking about. An existing client that had a very, very standard portfolio. It's actually an execution-only mandate, and they'd had a basket of assets in there. They'd inherited them essentially, but they had that emotional attachment to those assets, and those assets were in the energy sector and in the tobacco sector. And whilst they absolutely, when we had the conversation with them, mentally they were prepared, they were ready, they wanted to realign to their very clear ESG goals, but there was still a sort of an emotional encumbrance there somehow, that kind of ownership. They'd had dividends from those assets. They'd held them, or their family had held them for many decades. And I think what we're starting to see more and more is that there's almost an emotional transitional period of reallocation that needs to be considered sensitively. And I think that probably is something that family offices and trustees in general are starting to figure a little bit more now. And I do think that conversation piece, I know sort of in a way you could try and do that work for them, but that conversation has to be thought out, discussed between family and trustee, and it can be there can be input, I think, from a manager to almost say, well, look, these are the areas that we're considering, that we're looking at, and I think when you get those 2 points coming together, you actually end up with a portfolio ambition. You might know where you want to get to in 6 months, 12 months, 5 years time. I think it's then about mapping that journey and what are the steps that a client might want to see now, whether that's starting to divest from the most toxic assets, or to make some positive inclusions, to maybe add a theme like biodiversity into an existing strategy. So I think that probably the finishing point before we move on to the Q&A section is that tailoring element. I think you have to have that ability to adapt and look at a strategy that's suitable for a client, rather than sort of, as managers have a tendency to do, is say, look, here's our offering, take it or leave it. And I think actually that's one of the points we really like getting into those conversations with clients and with trustees to really understand sort of where their clients are in their thinking, and then shape offerings around that.
Makes so much sense.
So one thing we always do on all of our ESG webinars, and a few of you will have seen me trot this phrase out again. Well, it's not my phrase, it's David Attenborough's, but I think it really kind of, it's once you think it, you can't unthink it. It's crazy that our banks and our pensions are investing in fossil fuels when these are the very things that are jeopardizing the future that we're saving for. I think in this instance, I think you could substitute investing in fossil fuels for investing in companies that are causing nature loss and have poor land use practices. I think it's as relevant for biodiversity as it is for climate change. So hopefully that's been useful. I know we've kind of rattled through quite a lot of technical detail there on biodiversity, as well as those 7 steps. We will share the slides. We are, of course, available offline to have conversations. But if you do have I'll just stop sharing the slides. If you do have any questions, please do pop the details down in the chat channel, and we will just go and have a quick look at the poll responses. I don't know whether anybody has used the poll. If not, no problem. We can do that as a follow-up part. So just having a look to see if there are any questions there. If not, Tom, maybe I can ask you a question or two, just in terms of how do you go about accessing some of these private equity biodiversity opportunities? What tends to be the process there?
Ultimately, it's a network. I think is the short answer to that, Greg. There are agents, for want of a better word, who've been active in this field for a long time, as I say, and you observe that a number of them will have transitioned from the energy market or renewable energy market into broader sustainable aspects. It slightly gives short shrift to traditional players who are also looking for the opportunities in this space, and large brands, buyout funds similarly will have ESG criteria, quite rightly now, and some of them are putting together thematic strategies that look at sustainable investment opportunities, which inevitably begin to encounter biodiversity opportunities. The question is, of course, how many of them are such, of sufficient scale for the large sponsors to be investing in. We're seeing some, without a doubt, but for the most part, I think the opportunity and therefore the high return opportunity is within the SME marketplace, which benefits the specialist players who have obviously a track record, which investors will be looking for.
Thank you, Tom. And we have had one question from Iskra, so thank you for that. So do you have a view on the engagement versus divestment debate? And I think that's a great question. It's one that we think about as a manager all the time. So I might have first go at that and then come to you, Tom, if I may. I think in some instances you conduct your general ESG analysis and your biodiversity analysis, and you arrive at a point where you either take the approach of, well, let's try and engage, and through that engagement process, depending on the severity of it, you assess what the response is and whether you think there is going to be any meaningful change there. And we were talking to a manager yesterday that we work with, and they'd been through that process with a company that unfortunately had some exposure to the Grenfell disaster, and they went out and they talked to that company, and the company said, look, it's kind of, it wasn't really our fault. We weren't really at fault for any of this, and that was enough for the manager to say, well, actually, no, sorry, there's obviously no sort of real engagement happening here. We're divesting and giving notice. I think what you're seeing more and more now is that it's not necessarily the investment desk decision, that it will be the ESG committee or the ESG team's decision on a particular asset that has the override. So an investment manager might still want to retain an asset or hold an asset, but actually, if we see a material ESG or biodiversity issue, then we're going to be flagging that with the head of equity and saying, look, actually, we need a serious conversation about this and how we're going to handle it, whether that is through an engagement process or through a divestment there and then approach. I hope that kind of helps to answer it. I think it often is asset by asset, case by case, and you've got to conduct your own analysis. I mean, Tom, you must have seen this in we're talking with families in terms of how they approach it.
And indeed, you do get differing views, of course, and it's important that people understand the implications of taking one stance from divest versus engagement. Let me add something else, of course. Given the weight of assets that are following rules-based investment, algorithmic flows, etc., that also needs to be considered. And indeed, increasingly ESG criteria be included in shorting strategies as well. And there are any number of activists put on sustainability grounds who will be shorting stocks as well. So, there are different ways of achieving an outcome. I'm a big supporter of engagement and actually clubbing up managers working together around issues is sometimes seen around certain protocols. UNEP often provides a forum for that, is another way of affecting change. Asset owner, engagement. So I don't think there's one rule. Just be aware of the investment implications of the position that you're taking.
Yeah, I mean, we see it quite often. So if we receive a portfolio in specie, that there will be sort of legacy issues, and you get that with traditional portfolios as well. But there might be some legacy ESG issues there, and you might formulate a plan where you say, look, over the next 6 to 12 months, these aren't positions that we want to hold long term. Anything but in some instances, but that doesn't mean that you're making a decision there and then to exit at any price. I think you have to be sensible, pragmatic about that process. Obviously, if a client says, look, actually, there's something in here that I just really don't like, then as managers we're going to be responsive to that. But hopefully the analysis, our processes are pretty robust in terms of making sure that exposure is very well managed. And coming back to one of the points you made, Tom, I think you do get some companies that have very complex issues where they might be positive in one area and quite negative in another. And I think in that instance, it's really what is the mandate and is it applicable to your mandate, and making sure it's the decision is made on that basis. We've seen some companies that are very positive within the water sector, for example, but are dreadful from a packaging perspective. Or people might have strongly held views in one area of their business. And I think that's one of the almost, yes, there's us as managers engaging with the end companies or with managers holding those companies. There's also an engagement point that trustees should have with a discretionary manager. And if you like, you can look forward to having that role of asking those ESG related questions in the same way as you ask any investment questions.
Absolutely.
So just having a look and seeing whether we have had any other questions. We're just sort of coming up to the hour. So, I mean, Tom, thank you ever so much for joining us. When we were putting this webinar together, we realized quickly that we had a lot of content on biodiversity that Tom and I both wanted to talk about, but also we'd had questions previously from trustees attending saying, well, what do you do about ESG objectives and what are the kind of technical approaches? So the plan is we'll put on a second webinar where we'll probably put on two. One where we'll go into more detail around biodiversity specific subjects. So if there's anyone dialed in that would like to join and really get to know that in a lot more detail, we'll send an invite. Likewise, if you're a trust administrator and you're really thinking, okay, I need to do something in this area and build up my technical knowledge, we'll also go into another technical guide for implementing ESG and biodiversity. So if I may, I'll just sort of thank everyone for joining us today. We always really appreciate it. I think we were up sort of 30, 35, 40 attendees at one stage. And I know it's summer in the UK, the sun's shining, the Euros are on, everyone wants to meet in person. We weren't sure how many we'd get for a webinar. So really appreciate you all taking your time, and look forward to speaking with you all again soon.
Thanks so much, Craig.
Thank you, Tom. Talk soon. Bye for now.